If you look at the modern stock market, it feels entirely overwhelming. Millions of data points flash by every second, and retail investors drain their energy trying to time exactly when to jump in and out of the chaos. Most people assume that to beat this system, you need a finance MBA, advanced Excel modeling skills, or some kind of insider knowledge. Curious, but this chart shows a reality check. A few years ago, a group of 7th graders at St. Agnes School built a stock portfolio that generated a 70% return over 2 years. The S&P 500 index over that same period grew by only 26%. A group of kids crushed the market average. Warren Buffett did something similar when he was 10 years old. He would go to the Ak-Sar-Ben horse racing track after the races ended. While everyone else was focused on the complex math of picking a winner, he simply walked the massive dirt tracks and grandstands, looking down to find discarded winning tickets, thrown away by drunk or careless adults. Neither the 7th graders nor a 10-year-old Warren Buffett used advanced mathematics. They succeeded because they applied a very strict process of elimination to filter out the losers. Successful investing isn't about perfectly predicting the market. It is about building a strict funnel. You take in the noise, pass it through specific filters, and only invest in the few clean ideas that survive the drop to the bottom. The very top of this funnel requires massive data intake. Money compounds, yes, but knowledge compounds faster. You have to feed your brain before you feed your portfolio. Early in his career, Buffett spent 5 to 6 hours a day reading Moody's manuals, thick books filled with tiny text detailing the raw financials of thousands of companies. He was constantly dumping new data into the top of his funnel. But sourcing data doesn't only happen in spreadsheets. You can fill the funnel simply by observing the products people love and buy in your daily life. Investor Peter Lynch proved this when he noticed his 3 daughters ignoring their usual clothing stores at the mall and instead flocking to a place called the Body Shop. He saw the store was packed with women buying lotions and creams. He pulled their annual reports the next day, loved the numbers, and bought the stock before it multiplied in value. When you're sourcing these ideas, this diagram shows why you should look at small companies. A small business with a tiny market cap has the mathematical runway to multiply its value 10 times. A massive conglomerate like Reliance is already so large that expanding by that same 10 times multiplier hits a physical ceiling. There simply isn't enough money in the market to push it that high. Huge institutional investors and billionaires manage so much capital that they literally cannot invest in these tiny companies without buying the whole business. They are forced to ignore them entirely, leaving a highly profitable blind spot wide open for retail investors. So, the top of your funnel is fueled by aggressive reading, paying attention to what people actually buy, and hunting in the small cap markets that the Wall Street giants are forced to ignore. Once you have a list of interesting companies, they drop into the middle of the funnel. This is where you apply severe vetting to ruthlessly eliminate bad ideas. First is the crayon test. If you cannot explain exactly what a company makes and how they make money using language simple enough for a child to understand, throw the stock out. If it passes that test, you move to the financials, specifically looking out for the illusion of standard earnings. A company can claim millions in profit on paper based on invoices they sent out, even if they haven't actually collected a single cent of that money yet. This formula shows the ultimate financial filter, free cash flow. It represents the actual money left in the bank after a business pays for all the equipment and operations needed to keep running. You calculate it by taking the operating cash flow and subtracting the capital expenditures. If we look at Reliance Industries around March 2021, their standard profit and loss statement showed positive earnings of over 49,000 crores. On paper, they looked highly profitable. But if you checked their actual free cash flow during that same period, it was negative 13,500 crores. Despite the reported profit, the company was heavily bleeding cash to maintain its operations. Any company that survives the middle of your funnel must be conceptually simple to understand, and it must survive the harsh mathematical reality of positive free cash flow. At the very bottom of the funnel, you don't end up with 50 random stocks. The goal here is extreme concentration. The human brain has a strict cognitive limit. You can really only track and remain deeply informed on a maximum of 8 to 15 companies at any given time. Warren Buffett operates on an even tighter margin. His absolute rule is that finding just 3 truly wonderful businesses over your life is more than enough to build massive generational wealth. Reaching this level of concentration requires a psychological shift. You have to stop viewing stock purchases as trading digital tickers on a screen and start viewing it as signing a 100-page long-term partnership contract with the owner of the business. Real investing isn't about frantic action. It is the quiet discipline of feeding thousands of ideas into a funnel, letting almost all of them fall away, and having the patience to hold on to the 3 or 4 incredible companies that survive. To keep the top of that funnel full, you need to constantly compound your knowledge. The Giggle app is built exactly for this, giving you access to over 1,000 book summaries in Hindi that you can read or listen to daily to uncover your next great idea.